Okay. So we are now live in Clubhouse, live on YouTube, and I am going to, it will echo in just 2 seconds. Okay. There you go. I'm getting the hang of it. Now I know that you need to mute the echo. There you go. Woo. So now we are all about foreclosures and foreclosure alternatives. This is Michelle J. Adams. She is an attorney with Adams Morris and Sessings in Germantown, Maryland. So the neat part is that Michelle and I have known each other a very long time. And Michelle has been a guest on my Sirius XM radio show for so many times. And I hate to say the last time we had just a lot of short sales and foreclosures that were just flooding the market, and people just did not understand what they were. And I feel so grateful. I'm just going to say this so I don't forget, Michelle. I'm so grateful because I know personally how many people that you helped that were listeners of the radio show, of my radio show. And I know just people that you've really helped them find solutions and also confront the I want to say the scariness and the unknowns, especially on the legal side of it, because so often people are talking and they really don't understand foreclosures and short sales, and they're just giving, I want to say bad advice, but they're giving the wrong advice. And so I am so grateful for all the people that I know personally that you have helped. So today, I asked you to please come and let's talk about all of the changes. We're actually technically still in August in the year 2021. So if you're watching this at some other time, just know that we're talking about all the newest and the latest things about foreclosures, and we'll touch on short sales a little bit, but we really want to make sure that you understand what's happening and what are some of the new laws. What's the latest? I don't know if we're going to call it the greatest, but the latest and the newest stuff that's out there that is going to impact anyone who is struggling with paying mortgages and what that goes. So Michelle Adams, and I guess the one other thing I'd love to tell people is you've been in business. This is your firm. And I love the fact that you established it years ago, but will you also talk a little bit about your background before we jump right into the presentation?
Sure. So I kind of got into what I do now just because there was a need. I graduated law school. Initially, I worked in product liability litigation for a large firm. And when I had a son, I decided that that wasn't what I wanted to do anymore. And I did not want to work 80-hour weeks, at least not for somebody else. And so I went through a, what am I going to do when I grow up kind of phase. And at the same time, around 2008, there was a foreclosure crisis, and the judges were asking attorneys to please volunteer and help and come in and get training. And so I did, and I met a lot of other like-minded people, and that's kind of where it began in 2008, and kind of been working in distressed real estate, debt, and helping homeowners and just people who are trying to climb back out since then. Opened our firm in 2013 with 2 other partners. And so, we've been going strong since then.
And you have your partners also help with bankruptcy and other aspects of, as you call, distressed properties, right?
Yeah. We, and I also say distressed people, because it would kind of deal with, people who are often in all kinds of binds, so we have bankruptcy and corporate law, family law, and some civil litigation. But for a long time now, predominantly, we've been handling distressed properties.
Yeah. So. Well, and it's good to know that people know that. So again, Michelle Adams, and in Germantown, Maryland. If you're watching this on YouTube, of course, she has her email address up there, and she is always happy to answer questions. So at the end of this presentation, we're definitely going to open it to questions. Anyone who has questions, feel free to stick around and ask questions. Welcome to everybody who's in the audience. So Michelle, I'm going to let you take it away.
Okay. Well, so sort of this is about foreclosure alternatives. So, in the current climate, we've had 7 million homeowners in the United States that have taken advantage of forbearance agreements during COVID. And to deal with all of this, there's been a lot of new rules that had to be implemented by the Consumer Protection, I remember CFPB, Consumer Financial Protection Bureau, so that they can ensure that servicers and everyone were handling these loans in ways that would be the same for everybody. I'm going to put my disclaimer is that this is a presentation, informational purposes. Yeah, I am an attorney, but this is not legal advice that I'm providing. This is information. If you have a specific situation, you definitely want to speak with an attorney within your own state, because things do vary state by state. So the first question, not everybody knows, what is a foreclosure, right? And the type of foreclosure that we're talking about today is when a bank is actually trying to get back, a collateral for a loan. So, if a person has taken out a mortgage, the property is actually the security. So the bank is then attempting to get back their security. That was the asset that was used for the loan. So when can a bank foreclose on a property? So it used to be state by state, it was different. And so depending on where you were, you could be in foreclosure sometimes in as little as 60 days behind on your mortgage. The bank could send a letter and say, we're going to start the foreclosure process. But this all changed. I think it was in 2011. They made it a national standard that you had to be at least 120 days behind on your mortgage before the bank could start any kind of foreclosure process. This was actually really good in most states. I live in Maryland. So for Maryland, an example, it was 90 days prior to this rule. So, that kind of gave everybody an extra month. Virginia, I think it was 60, so having this kind of standard, I can tell you in a lot of states, it's way longer than 120 days. But at least that is the minimum. With the new rules, they're only going to apply to people who fell behind on their mortgage after March 1st of 2020. So for homeowners who were in default prior to COVID, these new rules don't actually apply to them, but the bank can choose to apply the same rules to all homeowners, but it's completely at their discretion.
Wow, that's a really interesting difference than way back when we were facing a lot of this last time. So I think I want to interrupt you just for a second to repeat that. So March 1st, 2020, that's a date. I almost feel like that's a date that will live in infamy.
Yeah.
It's going to be a date I think you're going to see on a lot of things that happen with distressed real estate property. So March 1st, 2020. Okay, good.
Yep. So it used to be that for foreclosure alternatives to kick in, right, you have to be, first you have to be in default, right? You have to have missed a mortgage payment. And typically there has to be some kind of financial hardship. There are other hardships, divorce, a death in the family, things like this, but typically it has to be something that would then cause a person to be in financial distress, right? So when you're in default and you're in a situation where you've already passed that 120 days, okay, so now you're at a point where, okay, what are some alternatives that could help you so that your property just doesn't go to foreclosure? So there are options that are offered by the lender. These are called loss mitigation options, and everything, loan mod, short sale, deed in lieu. And I'll say what those are again in another slide, but those are all things that your lender can provide, right? They're not a guarantee. There's no right to them. It is all at your lender's discretion, but those are options that are available. Bankruptcy is another way that a person could avoid foreclosure. Again, that's something that an individual would have to pursue on their own. Or litigation. There are what's called consumer protection lawsuits. So if a person feels like their servicer was not following like their guidelines, or they something else was going wrong with the loan and they've spoken with someone who has reviewed everything, there are options for potentially suing the bank. So
And that
loss.
happened last
Mhm.
time. There were definitely, we talked about that a lot on SiriusXM about the fact that there were times when people had to sue the bank because there were things that were in the bank situation, which is different than now with the pandemic, right?
Right. So, I mean, there could potentially still be reasons for someone to try to sue even during COVID-19. I mean, there are servicer guidelines for pretty much every servicer. Now, to step back for a second, so servicer is, the person who's actually sending out the mortgage statement. That's not always the person that owns the loan. So the servicer has to actually get, what are the guidelines for this loan from the person that owns it. And so just as a basic example, you may be getting your statements from Bank of America, but does not mean that Bank of America actually owns the note. It could be this, Series 12 Pool 13, and that was, in some mutual fund that now owns your loan. And so they write the guidelines for your loan. If the servicer does not follow them, or there's something within those guidelines that seems to violate other rules, then there might be, a reason for litigation. But everything keeps getting narrowed. The reasons why you can go after the bank seems to get smaller and smaller. Loss mitigation itself is broken out into whether you're trying to keep your home or you're going to sell your home. So for home retention, some of the ways that you could avoid foreclosure, first would be a refinance. So if you're refinancing, you're not behind on your mortgage, because once you're behind on the mortgage, you're in default. It's affected your credit. You're not going to be able to go to another bank and refinance your loan. So that one is usually out by the time you're in default. Forbearance, this is where this 7 million people have fallen into. This is basically not paying your mortgage, but it's not getting reported on your credit as being in default. And it's not going to go away. They're just putting all of this money that you're not paying kind of into a pool, so to speak. And at some point, you're going to have to deal with it. And it's going to be, again, at the bank's discretion, what they're going to do with this pool of funds that you're going to owe at the end of a forbearance plan. One of the ways that they'll deal with someone who falls behind is a repayment plan. When I say short term or long term, short is probably like 3 months, long term, maybe 8 or 9 months. They're not very long. And you can imagine somebody's fallen behind on their mortgage. They want to get back into good standing. They have to not only make their mortgage payment, their regular payment, but now they have to make a payment plan payment on top of it. So while their regular mortgage payment might be affordable, I don't know how affordable it's going to be for most people to have double, and if you missed 12 months of payments and they put you on a 6-month repayment plan, that means it's basically going to be a double payment plus what you owed. So that's 3 payments per month, basically, versus what you were paying before. So majority of people are going to fall into a loan modification. And types of loan modifications that are out there, a balloon, which is, if people are familiar with what a balloon mortgage is, it's similar and different. When you get a balloon mortgage, usually there's a time frame. Say you took out your mortgage in 15 years, you have to pay it back, but it's amortized over 30, so at the end of 15 years, you're still going to owe a balance, and that has to be paid in one lump sum. In these loan modifications, the balloon is like a second deed of trust. It sits at the end and it doesn't get paid until you sell the property or refinance, one or the other. But you don't have to pay anything on it. It's not amortized. There's no interest. It just sits as a lump sum to be paid at the end. Recapitalization is when they take that amount that was owed and they add it back to the original principal, and then they take your 30-year time frame and your interest rate and they recalculate your payment. So recapitalization typically results in a higher payment, but not always, because they can, going to the next one, they can lower the interest rate and they can extend the length of time of the loan. So when they add in, I like to use round numbers. It makes it easier. So when they add in 50,000 to your original balance of 250, you're now at 300. And if they were to recapitalize that on your old interest rate, your payment would go up. The goal of a loan mod typically is for the payment to go down. So they could start saying, okay, we're at 4.3%. We're now going to go to 3.3. Okay, that's still too high. We're going to go to 2.3. And then they say, bingo, okay, here we are, 2.3%. We're now hit a payment that's affordable. For some, because they're so far behind, even lowering the interest rate's not enough. So then they're like, okay, we're at 2%. We can't go lower than 2%. So now we're going to make it a 35-year loan, or we're going to make it a 40-year loan, so that we can bring the payment down. The last option for lenders, principal forgiveness. I don't think we're going to see this round. We saw this under the Making Homes Affordable program that ended in 2016, but it was due to incentives for the banks. You know, if the bank agreed to forgive a portion of the debt, the federal government agreed to give them that money back. So I think my cat is peeking in on the corner here.
Yes, you're definitely
Yeah,
getting a cameo of the
hey,
cat, which is great. I
yeah.
love it.
Hi, Kemba. Okay. So, so as I was saying, I don't think we're going to see principal forgiveness this time around unless some programs come out. And you know, there's already been, you know, we had the CARES Act, and we've had additional COVID acts that have come out. Actually, these forbearances originally were part of the original CARES Act. That's where they came from. So, you know, it's possible that something else could be passed that could come around that was like making homes affordable. But we can already see the difference this time around. Last time, everything was focused on the banks. If you remember, it was bailouts and making sure too big to fail. And then there was sort of an outcry of, well, who's helping Main Street if they're just helping Wall Street? And this time they went straight to Main Street. They basically said, this is what's going to help the homeowners, and banks, this is what you're required to do. You know, you're required to give them forbearance plans. You are required to waive any interest, you know, on those missing payments. You know, it's interesting to, especially seeing what happened in 2008. It's interesting to see what's happening now, because it is different. Okay, so if home retention is not a possibility, other loss mitigation options are, you know, the sale and transfer of property. And what falls under a sale is your traditional equity sale, where you'd have, you know, time to list the property and you pay off all of the liens that are against the property. That's just a normal sale. Even with the person, you know, in default, behind on their mortgage, you know, it doesn't matter. If you got equity, you have equity. You can sell it yourself. Short sale, this is, you know, at this point, your equity has been used up. You owe more than what your property is worth. It entails applications, approvals, and 60 to 90 days minimum for a bank to review it. So there needs to be time in that foreclosure process. And other liens.
I know, before we go on to the next one, on short sales, one of the things that I know you worked a lot on those years ago, and that's been one because people were upside down. So many people were upside down with their equity. Will you talk a little bit more about when someone is upside down, what are some of the options that are available to them? I know real estate investors also look for people who are in that situation as well.
And you know, for the record, from my perspective, just because you mentioned the investors, you know, when a property is short, you have to go to the servicer and then the investor to get approval to sell the property. You know, all of the fees and everything that go along with selling a property, all the traditional fees, you know, commissions and, okay, my cat is, okay. I thought he was going to step on my laptop. Transfer recordation, you know, all of those things are all going to get paid by the bank. So the entire process is, and there's an addendum usually that's, you know, subject to third-party approval.
Right.
So, you know, the homeowner is going to be able to typically not have to bring any money to closing, and the bank is going to cover everything. And the problem, what I think is going to happen, and we talked about this for a few minutes yesterday on the phone, was, are we going to see short sales based on this current climate and what's going on with these forbearance agreements? And, I think that's really going to depend on how long somebody had their mortgage, how much they'd paid off at the time, what was their equity, 18 months ago. Because if you haven't made a mortgage payment in 18 months, is your mortgage payment $1,000? Is your mortgage payment $5,000? Is it $10,000? And we deal with all of that. We have people who come in that need to do short sales for a $80,000 condo, and then we have $3 million Potomac homes. It does not matter what the price range of the property is. Short is short, and hardship is, I always say there's varying perspectives on hardship. If you lost your job, you lost your job. It doesn't matter what that job was. Having a mortgage is just not affordable. Even if it was at one time $10,000, you're still in the same boat as a person whose mortgage was $1,000. And the process is the same for both, as far as how long it takes and everything else. So will we see more of these? I think if we do, it's going to be a little while. Say that some of these people are able to get some loan modifications, right? And I'm going to go into this a little bit more in a later screen, but the type of loan mod that majority of the banks are talking about is this balloon one that I was mentioning, or they call it a deferred balance. They have a bunch of different names for it, but essentially taking the entire amount that is behind and putting it as a second deed of trust. So in 2008 through 11, 12, 13, a lot of times people were short by their second mortgage amount and not always by the first, because everyone took out, wait for it, home equity loans, right? And so,
Right.
Everybody was borrowing against their equity. And then when the market dropped and real estate was no longer worth, what it was when they had those appraisals done, they couldn't, they wanted to sell their property. And now that 80,000 extra that they took out, there was only like 10 to pay it back. So that's the part that I'm worried about, is that if they do these balloon deferred balance loan mods, put it on the end, people are going to be paying only on the amortized amount, not what that's the amount of that second. And that if something comes up in the next year or two, that they're still going to owe too much when you add the two together. I don't know that it's going to be immediate, but I was listening to something on the news yesterday where they were talking about a lot of these loans that people have been taking out this year, where they're putting 5% down. And it's a, much higher price that people are paying. I'd say, a lot of people were waiving their appraisals, or they were agreeing in their contracts that they would bring the difference between the appraisal and their purchase price and pay it in cash. And so if something happens to them where they need to move in the next year or 2 years, and the market corrects itself, they put 5% down and it corrects by 10%, they're short.
Yeah.
And that's the way it's going to be. So I don't think short sales are going away anytime soon. It's been, this year, everything's been just on hold. Everybody's mortgages, are pretty much on hold. So we see very few of them right now, but there are a handful. If somebody has to move, even if they've been in a forbearance and their property is underwater, it's a short sale. But there just hasn't been any foreclosure pressure. So it hasn't been what it's been in the past, but that's coming, right? Because all of these moratoriums are being lifted. I think yesterday the eviction ban was just overruled again. So, I think that in the fall through winter, we'll see, unless the states end up doing something specific, there's no federal ban anymore.
Right. Which is definitely going to shift things for real estate investors as well. For renters, it's going to shift things.
Yeah.
And then if they have a mortgage on the property, that again shifts things.
Right. So the other option sorry, I'm squirming a little. So after short sale, deed in lieu, again, this is where a homeowner can agree with the bank that they're going to basically hand them back the keys and say, here, I'm going to sign this deed. I'm going to give the property back to you. And in exchange for me, homeowner, agreeing that I'm going to do that, you bank are going to agree that you're going to waive any of the deficiency. You're not going to come after me for the difference. So, the house is what you're getting back, and I'm not going to owe you any more money. This again goes through an application approval, same 60, 90 days. There has to really be only one mortgage. Potentially there could be a second if the second is willing to work with the first to accept, a small payoff. But other judgment liens, if somebody has IRS judgments, state judgments, credit card judgments, any of that, then deed in lieu is not going to be an option, because none of those are going to get paid, and you can't sell the property without releasing all the liens.
Yeah. And that's something that I think is the real gotcha that most people don't understand with a deed in lieu, because they think that that's going to be the solution. And then they wait and wait and wait, and they don't realize that it can really, it could not, there's details that you need to know about your situation. And I think you and I used to talk about this on SiriusXM a lot, is that every single house, every single situation is like a fingerprint.
Yeah.
It's that specific and it's that different. So as much as we're going through this, presentation and trying to make sure we're educating as many people as possible, we're also realizing that, if you have a question, feel free to call Michelle and ask her. She's great at making sure that, she'll make herself available, email, phones to answer questions. But, look at all the options and don't continue to just wait and wait and wait and wait.
It is a big problem. And I unfortunately get a lot of people too late. Someone will come to me after they already have a sale date scheduled and they want to know what their alternatives are. And at that point, unfortunately, they may be narrowed down to just bankruptcy, because they're trying to stop a sale date at that point. Or they have been told that deed in lieu would be the best thing for them, from a friend or somebody, and turns out, as I said, they have all these other liens against them. Deed in lieu is not even an option, and they waited so long that they may not have any alternatives. They may not be a good bankruptcy client, in which case they may have no other foreclosure alternatives. It may be that their property just goes to foreclosure at that point. I mean, the banks, they are not like an entity with a heart. This is not somebody who cares. They're not,
No.
They are a business, and they either want their money or their asset,
Yeah, it's definitely a financial transaction, and they're not interested in they don't care. Banks don't have, I love that. Banks don't necessarily have a heart. They don't really care about your situation or, whatever problems you faced, or losing your job, or having a divorce, or anything that's happened. They're really looking at the bottom line and the financial aspects of it.
Right. In fact, I often tell people, applications for any of these loss mitigation alternatives require a hardship letter, and people really spend a lot of time, make these very long hardship letters. I've gotten some that were like 3 pages long, and I'll have to tell people, I'm like, be really specific, short, bullet point. All the bank wants to know is, from when you purchased it, why are you selling it now? Or if you're getting a loan modification, what is it that caused the initial default? That's all they want to know. But I get the letters that still go back and they give the full market analysis of 2018 and how they bought at the high, and they, the appraiser was probably in on it, and the lender gave them a loan they shouldn't have received. Nobody's actually reading this full letter. They just are scanning for the, and that's when I fell behind. That's it. When did you fall behind and why? And that's it. And because the bank doesn't care otherwise, you have to, it's checking a box, they're like, here's our 15 reasons why a person could fall behind that we will accept. And if you don't fall into one of these boxes, then we can't help you. So please pick one. That's it. Just pick one.
Yep.
Or pick 3 if 3 apply.
Right.
But that's it. But as I was saying, when it gets too late, at some point, bankruptcy may be another option. If someone files a Chapter 13, they can get into a repayment plan that is longer than, say, the bank is willing to offer them. And this can actually be a pretty good option for some of these people that are coming off their forbearance. If the loan mod does not look like something that they are willing to enter into, or it's just not going to help them, then a 13 is something that kind of forces the bank to work with you because they have to accept it. They don't have a choice. Once the court approves your repayment plan, and like I said, you have up to 5 years to repay the balance. It does get paid in full. There is no discount on it like there are for like the credit cards and things like that. You may get like you may only be paying back a percentage. In the mortgage, you're paying back everything that you owe, but you get more time. If somebody's at the point where they're filing a 7, they're basically giving up their assets. They're at that point, they're saying like, I'm done. I don't want to pay. I can't pay any of this back. So I just want to get discharged and I surrender my home. You can have certain assets that you exempt. But that, again, that would be very specific, and that requires a consult with a bankruptcy attorney to figure out exactly how that would work. But in perspective of foreclosure alternative, it stops the foreclosure timeline. So while you're in bankruptcy, everything else is stayed.
I know that a lot of people go to that. They go to bankruptcy, whichever chapter 7 or whatever, in that they're looking for an alternative or a way to stop or pause things, while they're looking for other solutions or trying to reorganize or looking for another job, or again, just looking for other solutions. So that's one of the reasons I mentioned at the top of the hour that you also have somebody on in the firm who also just specializes just in bankruptcy. So if it goes that direction, you want to talk to an expert. Don't go at it alone. Don't try to do it by yourself.
No, and some people actually do try to file, and I can imagine it's very difficult making all of the court dates and knowing exactly what you need. But the bankruptcy is a last option. There are plenty of people who use it that way as like a emergency stop foreclosure, because you can file bankruptcy up until basically the exact time of a foreclosure auction sale and stop it. And then it has to be stopped. If they went through with it, they have to undo it because the bankruptcy just stops everything. And then litigation was one of the last options of a way that you could stop the foreclosure proceeding, because once the court gets notice that there's another proceeding, they have to put the foreclosure on hold until the other case is worked out. And so typically the attorney that files, say if it was a consumer protection lawsuit, would also file in the foreclosure case and say that, this has to be on hold until this other issue is resolved. And so that can buy a lot of time. Foreclosure defenses, there's very few that are left at this point. That used to be something that was used a lot, probably through like 2013, but little by little, the states have been cutting away at what you can use as a defense in foreclosure. And so majority of the time, if you go to court with something, they won't, the judges have not been granting the motions to try to stop foreclosure. So getting into the new rule. So this is the 2021 COVID-19 rule is kind of what they're calling it. It goes into effect August 31st of this year. And it added procedural safeguards to ensure that a borrower has meaningful opportunity to apply for loss mitigation. Okay. And there is a streamline loan modification without a complete loss mitigation application. Now, this complete loss mitigation application is what is the big difference, right? And up until now, the banks would use the fact that your application was incomplete, and then they would decline it. And they would basically give you, a lot of homeowners probably very familiar with getting a letter that says, we've received your application. At this time, it is incomplete. You have until, and they give you a date to complete your application, or we will have to decline your request. What's interesting to me is that CFPB, when they passed the prior servicing guidelines, was supposed to be to help homeowners. So it gave them these servicer can't, it was set up like servicer can't deny your request, until it has been complete. Like, so that when you have all these documents coming in, they had to pause your foreclosure timeline. They had to wait until they've reviewed it. But the bank's attorneys then reviewed all of this, and they came out with their own spin on it. Their spin was, well, on the reverse, if you haven't completed your review, we don't have, or completed your application, we don't have to review it. We don't have to even look at it because it's not complete. And at the end of that timeline, when we give you that date, if you haven't completed it, we're just going to dismiss it. So that's what I saw. And that's what I still see, because they do the same thing in a short sale. You get this letter that says, your file is incomplete. You have until this date to complete it, or we're dismissing it. And they get to decide what's complete. So, is complete every single document, or is there a substantially complete kind of standard of, we've received it's called a request for mortgage assistance. That's like the 4 or 5 page application that each bank has. They filled that out. They gave their pay stubs. They gave their bank statements, their hardship letter. They sent their tax returns, all of these things. But one of the pages got cut off on the top and we can't read the date. Does that make it incomplete, or is that just a correction?
Oh, that's brutal. That can be awful.
Yeah. Or your tax returns came and I see, you signed it on the page we asked you to sign it, but you didn't date next to your signature. So we got to send that back to you for you to put a date next to your signature. Does that make it incomplete, or is that a correction? So we've dealt with a lot of that. So this changes things. They can now review your incomplete loss mitigation application. But this only applies to principal residence, no second homes, no investment, and no reverse mortgages, right? This is only a standard mortgages. So as I was saying, the pre-COVID, the foreclosure safeguard was you must have a complete loss mitigation application before they could refer your mortgage for foreclosure, before it could be sent to any law firm or any service that was going to set an auction date. They had to wait until they've had an opportunity to pursue loss mitigation, right? And when the application comes in, they were supposed to be reviewed for all options at one time and make a decision. It was called a waterfall. So they look at them for loan mod, short sale, deed in lieu, all at one time, regardless of the one that they actually want. They had to review them for all of them and then come back and say, okay, we reviewed you for all of these. Here's the ones that you qualify for, and here's the ones you don't qualify for. But again, had to be a complete application, or they had no requirement to review it. They could just cancel it out and effectively start foreclosure at that point and say, well, they had their opportunity and they didn't complete it, so we're moving on.
And I think a lot of people got caught in this because a lot of the phone calls I got for many years on the Sirius XM radio show was that people kept asking over and over, but I did everything. And then they were so frustrated. And I hate to say, but a lot of times it was something got missed in, like, when the bank was saying it was incomplete, maybe it was a piece of mail they didn't get, or however they communicated, they didn't know that their application was incomplete. And so by the time they found out, it was too late. And that became a huge problem.
Oh, yeah. And it used to be, and again, they've changed this a lot in, say, the last 5 years. They didn't always send these written notices. Back in the day, we had to call in constantly and say, how's my file? What's going on with my file? Do you have everything? And only by calling in would you find out they didn't have everything. It's not like anybody called you and left you a message and said, we got your application. Here's the 3 documents that are still missing, so that you could gather those 3 documents and send them in. You would send all your paperwork in, and a lot of homeowners would then make their assumption that it was a complete package. But things like pay stubs, right? Pay stubs come out every 2 weeks. So, or generally, it could be once a month, you know what I'm saying? It could be twice a month. So, but let's just say it's every other week. Every other week you have another pay stub coming out. If you're not sending them in as every single one comes out, then you're expiring and your financials expire. Now they have these letters that go out. There's a couple of servicers that are actually really good at this. I think it's SBS and SLS, when they send their letter out, we've received your application, they list every single document that's come in, and they have a column for whether it's been received, and then they have a column for when it expires. So when when you send stuff into them, they then send you a letter and says, if it still says it's incomplete, you can look at the next page to see why. And it'll say, out of date, bank statements out of date. And you're like, oh yeah, that's right. Gosh, today is, August 28th. So September 1, I'm going to have another bank statement that's going to come out, for the month of August. I better make sure I send my August bank statement in. And people just aren't, they don't always keep up with all of that.
Right.
So, so these forbearance agreements, let me just go back to these for a minute. So when these first started under the CARES Act, they actually were not in compliance with the servicing rules that were out at the time, right? Because basically you could call in, tell your lender that you were affected by COVID, and your lender was giving you a forbearance agreement without any documents, no financial review. So CFPB had to very quickly come out with a rule that said that the banks could actually do this. They could, over the phone, make a decision to put someone on a forbearance agreement without pay stubs, bank statements, tax returns, without any review, and just say, yep, you want a forbearance, we can give it to you. So they passed that rule. So because they literally had to say that we permit you, servicer, to do what you need to do, to allow these homeowners to not go into default. So that's what they did with these forbearance agreements. They delayed the paying of certain amounts until the mortgage is refinanced, or the mortgage property is sold, or the terms of the loan ends, right? And this is, at that time, only applied for FHA mortgages, right? That's what was in the actual CARES Act, was anything that was a federal loan. But for anyone that had a federal loan, at least they knew if they went into a forbearance plan, they knew that that amount was going to be added to the end. For everybody else, it was like, who knows what they're going to do with this amount. There was no actual requirement on the bank as to what they're going to do with it. So sort of gets us to the point of where we are now. What's going to happen with all of these people who are in forbearance agreements. Again, there's the incomplete review, and then there's going to be the complete review. The good thing is that the incomplete review is not going to count towards their attempts at loss mitigation. So if they get something offered to them on an incomplete review and it doesn't work out, or they fall into, they miss a payment or something, they get to apply again under the complete review. And all of this has to happen before the property can be referred for foreclosure. So there's a lot more protection right now.
So it's interesting because that August 31st date, which obviously is just a couple days away, that's 2021, year 2021. I wanted to emphasize that because, of course, you and I have talked so many times about short sales, foreclosures, the whole, all bankruptcy, all of it. And it's really important to understand that definitely everything, the whole landscape has changed in so many ways. And you need to look at the dates of when the new rules applied. And again, like this, like if you're looking at us on YouTube, this is 2021 COVID-19 temporary rule to avoid foreclosure. So it's important to know, again, when they change again. So do you have any idea as when the next round of changes are going to happen?
They haven't said anything. That the goal is that between August 31st and December 31st, I mean, this is when all of these forbearance agreements are supposed to end, so that by the time that all of the forbearance agreements end, all of these homeowners are in some kind of a loan modification. The different options that we talked about, whether they can recapitalize it, they can lengthen the length of the loan, all of those things can apply to anything other than these federal loans. So, the rule was really passed just to make sure that there was something that homeowners could rely on so that it wasn't just, hey, my servicer can do whatever they want.
Right.
It's no, and the one of the main requirements is that it has to make the payment be at least where it was or lower. It can't make it go up. So this time around, it really is it's about affordability and keeping the payment, where they could afford it before. They have no requirement to make it lower though. So this isn't the type of loan mod that people applied for when their mortgage payment became too high, which is the loan mod that we've seen up until now has been, well, my interest rate adjusted, or, my 5-year arm is over and now I'm paying on a, 25-year amortization, or my interest only is gone, whatever it is. That's not this. This is, I missed mortgage payments for 12 months and now I don't know what they're going to do with that amount. The only exceptions to this new rule are, again, loans where people were in default prior to the March 1 date of 2020. If they can prove that the property's been abandoned, or they try outreach and they don't reach anyone for 90 days, and they have to prove this all has to be certified, which, they never required. So all of these papers were going to have to be submitted to a court or to whatever it is in your state, to however they go to foreclosure in your state. There's going to have to be all these new certifications that they complied with all of this before they can start the referral for foreclosure. And someone's going to review it and say, oh, you missed 3 steps. They're going to make them go back. So at least they actually have this requirement. So as I was mentioning, the incomplete application, I'm going to kind of go through some of these because I know you want to leave some time for questions.
Yeah, and let me go ahead and tell anybody who's in Clubhouse, if you want to raise your hand, I can start bringing you guys up to the stage. If you want to ask questions, we'll do that. Just to remember to mute your mic as soon as you get up. We'd be perfect. Okay, good. Please continue. So Streamline loan modifications.
So under these Streamline so-called incomplete, and it doesn't have to be incomplete, it's just that they're allowed to start reviewing it even while it is incomplete, is that can't be more than 40 years from the effective date. So the maximum time frame is going to be a 40 year. The payment cannot increase beyond what the payment was prior to modification. For principal and interest, they have no control over the escrows for insurance, but the principal and interest can't go up. There can't be any interest on the delayed amount. So that's that balloon that may sit at the end as a second mortgage. It has to sit there as the exact amount. So the payoff will never change. Whatever the payoff is today, it's going to be in 20 years. Now, what is available for people that had a COVID-19 hardship can be made available to all borrowers, but it's not required. So that's this is specific to only people who, fell behind after March 1st and can relate it to a COVID-19 hardship. It has to end the delinquency. So you can't give a loan mod and then still call the person behind on their mortgage. And there can't be any charges, no fees for the modification. There used to be loan mods where they'd say, we'll give you the mod, but you have to put a $5,000 down payment down. None of that.
Right. I remember that. Yeah.
Yep. And there's a list of fees and penalties and all types of charges that they can't add on. So there's a list that's going to go to the servicer saying, nope, none of these fees are going to be allowed.
Right.
That those are fees that are after March of 2020. After they've done this first review, as I was saying, they can do another one. So if that initial review, that Streamline review, doesn't end up in a loan mod that works for them, they can actually reapply, and it's not going to hurt again. It's not going to hurt them. It's not going to count against them, and it won't be a subsequent review, because sometimes servicers will say we only allow for 1 review per year. They're not going to be allowed to do that. If the original one was an incomplete, now they're required to give them a complete review. There is a requirement for live contact. Again, like as I said, they're going to have to certify that they actually tried to reach out to the homeowners, and if they weren't able to reach them, they're going to have to tell them about all options that are available for their investor. This to me is huge as somebody who works with the banks. And I've had so many, as you were saying, like when we were talking about the deed in lieu, no, they didn't know that they weren't going to be able to get their other liens, taken care of as part of the deed in lieu, that it was going to be a problem, therefore they can't actually do the deed in lieu. A lot of times we would start a loan mod, we would submit the application, and the banks had been sending them loan mod applications for a year, and then they finally, filled one out, they sent it in, and 2 months later they come back and say, oh, we're sorry, your investor actually doesn't do loan mods. And you would think that they might know that at the beginning.
Yeah.
Now they're required to know that. So when you call in and you speak to somebody at the bank, they actually have to know the specifics for your investor. Not just, these are our servicing guidelines in general, go ahead and submit a loan mod package and, we'll get it to your investor and see what they want to do. No, they have to say right from the beginning, this is what your investor does and does not do. So I'm really hoping that that's going to make a change for most homeowners who, there were specific investors that we worked with that we just knew over time. If someone came to me and they told me, they showed me their paperwork and I'm like, oh, you're with Hudson City doesn't do, they don't do them. They just didn't do them. Now, this is not going to make banks do loan mods that don't do loan mods. That is still not a right. There's no right to it. But if your bank did a forbearance agreement and they fall under these servicing guidelines, then they're going to be required to review for a loan mod. So there are some borrowers that are not already in forbearance agreements. The rules are going to be different for them. The main difference is they have to contact them and tell them that they're eligible for a forbearance agreement. So if you're already in a forbearance agreement, when you get that live contact, they don't have to tell you that you're eligible for one because you're already in one. But if you're not already in one, the first thing out of their mouths has to be, you're also eligible for a forbearance agreement. And then they have to tell them about, here's all of your programs that are available. And this was interesting. They added a requirement that they tell them how to contact homeownership counseling. This used to be handled by the states. The state would send out paperwork and tell them how to reach out to a housing counselor. I've seen some of the paperwork, but now the bank has to do it. They actually have to give them contact information. So I think that's actually quite useful.
That was a huge problem before, is people just didn't know what their housing options were when they started to hit hard times. And again, it's just like anything else. If you've never been in that situation, if you've never touched it before, it's one of those things where a couple things. Number one, often people are embarrassed and upset and emotionally not making good decisions and afraid to ask. There's that whole fear barrier they have to get through so they can actually ask questions to find out. So that's a great new update there. I'm glad about that.
Yeah. So as I was saying, so for borrowers in forbearance, again, the only difference is that they have to be told of all available programs, minus having to be told about a forbearance because they're already in it. They have to be told when their forbearance is going to end, and how to contact counseling services. And contact has to be made before the end of the program. So they say between 10 and 45 days, they have to start contacting these people who are on forbearance plans and start trying to transition them into a long-term plan, so that they can get them back into compliance in their loan and no longer delinquent. Oh, look at that. That's it. That was the end of my program. So look, I got through it all.
Yay! Well, thank you. I mean, I love the presentation. And I think anyone who is in Clubhouse, if you want to go back, you can watch it on YouTube and see all the actual slides. But anyone who wants to go ahead, you can raise your hand now and we'll start with questions. I know, so I promised John Lee. John Lee is always here. I wanted to see, John, if you have any questions for our amazing attorney, Michelle Adams.
Yes, thank you, Jennifer. And thank you, Michelle, for all this information. I can't wait to go back and watch it on YouTube. I've got it on here now, and it's just so much. I just got one quick question. From a investor standpoint, if you're not getting, let's say, rent from one of your tenants due to COVID, and you can't make your mortgage payments because maybe you've got too much going on, how are you affected? Is that 120-day rule apply to investors also? And that's my question. Thank you.
So the 120 days applies to all mortgages, that they have to, you have to be a minimum of 120 days behind on a mortgage before you can be referred for foreclosure. It's the additional protections that on top of the 120 days that are only going to apply for non-investor loans. But it's up to the investor servicer. They are allowed to apply these programs to any loan. It's at their discretion. So that's the main difference.
Yeah, that's interesting that they get their discretion. Okay, let's go ahead. I want to make sure we get to David. David, I know you have a question for Michelle Adams. Please go ahead.
Yes, thank you, Jennifer and Michelle. So glad to meet you for the first time. I'm a real estate investor like most of the people on Clubhouse here, and negotiating short sales for 10 years. And I'll skip my bio. People on Clubhouse can read the profile. I basically buy houses and I negotiate short sales. I'm in St. Louis, Missouri. It's a non-judicial state. So that means it doesn't go through the court system. So, we don't really have a lot of attorneys that can help us in the state. So I do it because in all states, except a couple, any person can help a homeowner negotiate the short sale process. But, a lot of times, realtors try to do that, but they actually don't have the proper training. I'm an investor who's paid lots of money and do it full time. My questions are related to some nitty-gritty details. So, for example, one of the big things with all the loans that's going on now is sometimes these banks are selling these loans off. So do you know that if you had, say, a Freddie Mac loan, so you got FHA loans, Fannie Mae loans, Freddie Mac, let's say that it was a Freddie Mac loan when the homeowner took it out. If the bank goes and sells that loan, does it not become a Freddie Mac anymore? Do you have any idea of any experience with that?
Yeah, typically it's not that they sell it, it's the servicing that changes on it. So Freddie may have a 6-month servicing contract with SLS. And then at the end of the 6 months, they're not happy with the way SLS handled it. So they're transferring all of their loans to Rushmore, or, it's still Freddie that's the investor. I have some that you track it back, 8 years, and it's changed over to 4 or 5 different servicers, but at the end, it's still Freddie. It's rare for it to be a Fannie or a Freddie or an FHA, and that it actually gets sold off to a different investor versus just a servicer. And I'm sure that there are times where it may happen. I've not seen it. All of my loans that have come to me when they're Fannie, they've been Fannie, for years. They just keep switching servicers.
And I appreciate that. That's important because, as you know, there's a lot of little different details, and a homeowner absolutely must reach out to an attorney like you, or an investor who does short sales, or a realtor investor who does short sales. Because, for example, in Freddie Mac, to actually do the short sale, you have to get a buyer. To get a buyer, you have to list the home for sale with a realtor, and it actually has to be listed for 5 days active, but over the weekend. And that's different with FHA. So a lot of those rules are different with it. So knowing whether it's Freddie Mac or not, for example, then the bank comes out and does an appraisal. So my next question is, so if the bank sends somebody out to do an appraisal on the home to see what it's actually worth, because remember, it's a short sale, it means that you have to, accept less for it because you can't sell it and pay off the loan. The home is not worth as much. Does the banks have to accept the appraisal value, or can they just say they arbitrarily want a higher number? Do you have any experience with that? You have an appraisal amount, but then the bank says they want more. Are they allowed to do that?
Yeah, it does happen. I tell people it's not that common, but you're picking the right bank for the example there. Freddie, and sometimes Fannie, but usually Freddie, they have a formula that's not just based on the appraisal, that it also uses how much is, it's like they won't tell us what the formula is. They just say, based on our formula, you know, we can't accept this offer. And it's like how much is owed versus times how long the loan has been in default times 120% or whatever it is. But and when you question it, they say, too bad, this is what it is, we'll take it in foreclosure, even though we know that after foreclosure they're only going to get a, you know, 75% of what they already think is the value. It doesn't, they are allowed, you know, the only right that they have under that mortgage is to take back the property. Foreclosure is truly the only thing that's listed in the deed of trust as what they can, you know, absolutely do. These loss mitigation options, none of this is in the deed of trust. This is all at their discretion. So they can arbitrarily pick whatever reason not to work with us, you know, but it's very frustrating when they do that, because nobody is going to pay the price that they arbitrarily pick versus what the property is actually worth.
Right. And like, for example, FHA, they actually take a certain percentage of the appraisal value, but Freddie Mac, you know, you're saying does not do that. So that's great information, Michelle. I know, Jennifer, you have a time limit on these, so I could go on for the next. Maybe Michelle, if we can get together there, because you really know what you're doing, and I encourage all homeowners to seek out either a real estate investor who does short sales or an attorney who does short sales to help them through the process.
Well, David, it's always a pleasure. Thank you for all your questions. And yeah, I always try to make this just an hour because it's easy for this to go for 2 or 3 hours with no problem.
I can see that.
It could easily get into that. So again, the recording is up on YouTube. You guys can listen to it there. And as you know, John, anybody who's on stage, you know, the thing I want to do is, first of all, say thank you, Michelle. Thank you for spending an hour with us.
Yeah, no, thank you.
Thank you for sharing all of your insights. And I never got around to asking you to share some stories, but I know I'd love to have you back sometime in the fall and let's do an update of what's happening, but also share some stories, because I think we all learn from the stories of what goes right, but also what goes wrong, and how can we help our fellow man and woman, so we say. But again, Michelle, I thank you so much. And as you know, I'm always looking for the silver lining in life, and I'm known for saying, yay!
Yay!
So I'm going to ask everybody to come off your mics, and we'll go ahead and say yay as we end this room. So let's do 1, 2, 3. Yay!
Yay!
Thank you guys. Thanks for being here. There you go. Okay.